Okay, so let's just rip the Band-Aid off. Investing is a scam. I know that's a pretty provocative title, right? But let's be super clear. We're not saying that the act of investing is a scam. Not at all. What we're talking about is the way most of us are taught to invest. It's a system that's often built on some really flawed advice, some dangerous myths, and honestly, a whole lot of hope. That's the system we're here to dismantle.
So let's start with a really basic question for you. Think about your own financial plan. Your retirement accounts, your goals. Is it an actual system, something you understand and control, or is it kind of built on hope? Where you just toss money in, cross your fingers, and pray that in 30 years, everything just magically worked out. The difference between hoping and actually building a system is everything. And that's really the core of what we're going to unpack. And this right here gets to the absolute heart of the problem. This quote from Robert Kiyosaki just nails it. There's this massive conflict of interest in the financial world. You've got these so-called experts who've never actually done the things they're telling you to do. They might be amazing at selling financial products, but are they actually building their own wealth with those exact same products? A lot of the time, the answer is a big, fat no. They're salespeople, not investors with their own skin in the game. So here's our game plan for this explainer. First, we're going to dig into that first big myth, this idea that you should just blindly trust the experts. Then we'll get into myth number 2, the obsession with capital gains. After that, we're going to bust maybe the biggest, most sacred myth of all, just buy and hold. And don't worry, we're not just going to point out all the problems. We're going to build the solution, an alternative framework called the 4 pillars that'll help you shift from just hoping for the best to actually building your future. All right, let's get into it. Myth number 1, trust the experts. This is what we're all told from day one, right? Go see a financial planner, hand over your money, and just let them take care of it. The problem is, what you're often getting isn't really expert advice that's tailored to you. It's usually generic, one-size-fits-all advice that, frankly, often serves their bottom line more than yours. There's actually a term for this in the industry, boilerplate investing. It's where you walk in, they ask you a few super basic questions, your age, your income, maybe how much risk you can stomach, and then they just plug your answers into a formula, and out pops this prepackaged portfolio of mutual funds. Think of it like this. It's the fast food approach to your financial future. Sure, it's efficient for them, but it totally ignores who you are, what your actual goals are, and your unique situation. Now this is where it gets really interesting because it exposes the fundamental conflict in what everyone wants. See, a financial advisor, who's often really a salesperson, their goal is to sell their company's products and earn commissions and fees. They're often pushed to promote their own high-fee funds. But a real investor? They put their own skin in the game. They're focused on getting a specific result, not on making a commission. So let me ask you, who cares more about your money than you do? Yeah, the answer is nobody. So what does this boilerplate advice actually get you? Well, usually it's a 401k stuffed with mutual funds. But let's be real about what that means. Billions of dollars of your potential earnings can be eaten alive by fees. You can go through what some call a decade of nothing, where your account goes absolutely nowhere for 10 years straight. And get this, most of these funds aren't even trying to beat the market. They're just designed to mimic it, which means you're paying high fees for totally average performance. You have zero control, and this whole idea of diversification, well, when you only own paper assets, it's not real diversification. It's what some have called disworsification. You're not actually protected. And that brings us right to the second huge myth that keeps this whole boilerplate system chugging along. The idea that the whole point of investing is to chase capital gains. This is that buy low, sell high mantra we hear over and over. But think about it. When your entire strategy is based on the hope that a price will go up, are you really investing? Or are you just gambling? This slide just lays it all out, doesn't it? These are 2 completely different worlds. The capital gains mindset is all about speculation. You buy a stock and you hope, you pray it goes up. You have almost no control over that. The cash flow mindset is totally different. The goal isn't to sell the thing. The goal is to get paid while you own it. It's like buying a rental property that puts money in your pocket every single month, or owning a stock that pays you a nice steady dividend. You're building a business, not just placing a bet. Okay, I can already hear what you're thinking. Sure, building a cash flow business sounds great, but it sounds expensive. I don't have a few $100,000 lying around to buy a building. And that's the wall most people hit. But what if I told you the amount of money you have isn't the most important thing? What if control is way more important than capital? All right, let's walk through this analogy because honestly, it's a total game changer. Step 1 is about control.
Imagine a suit costs $1,000. You don't buy it. Instead, you put it on layaway for $0 down. Now, you don't own the suit, but what you have is the contract, the legal right to buy it at that price. That's control. Step 2, find a buyer. You go find someone who really, really wants that suit and is willing to pay $5,000 for it. Step 3, you sell the contract. You don't sell them the suit, you sell them your piece of paper, your right to buy, and you pocket a $4,000 profit. And here's the key, step 4. Your profit was made on a $0 investment. Because you never actually bought the suit, you only ever controlled it.
So what was your rate of return on that deal? Well, you made a $4,000 profit on a $0 investment. In math, what's any number divided by 0? It's infinity. You got an infinite return. Now, this isn't just a cute story. It's a principle. It's about using control, strategy, and other people's money to create returns instead of just using your own.
And that brings us to the third and maybe the most dangerous myth of them all, the one that's treated like a sacred cow, just buy and hold. The idea is you can't time the market, so just buy good stuff and hold on forever, through thick and thin. But what happens when the thin part is a total catastrophic crash? Being passive isn't a strategy. It's a huge, unmanaged risk. And this quote, man, it just hits you in the gut. The emotional pain, the financial devastation of just sitting there, passively watching your life savings just evaporate, all because you're supposed to hold on. A professional investor doesn't just ride the ship to the bottom of the ocean. They have a plan to get off before it sinks. And if you want to see what this looks like in the real world, look no further than Citigroup. If you were a buy and hold investor back in 2000, you watched your stock do absolutely nothing for 7 years. A decade of nothing. Then, 2008 happened. By 2012, that $550 stock was worth just $27. That's not an investment, that's a wealth destroyer. And that is the brutal reality of buy and hold when things go terribly wrong.
So here's the absolute crucial takeaway. The active, educated investor always has an exit strategy. It is your lifeboat. Look, the story of the Titanic isn't a tragedy if everyone has a lifeboat. The tragedy was the lack of an exit plan. And it's the same in investing. You can't control if the market's going to crash, but you can absolutely control whether or not you have a predefined plan to protect your money when it does. So what does a signal to get in the lifeboat actually look like? Well, here's a really simple but powerful tool called the double top pattern. Imagine a stock price is climbing, and it hits a peak. Then it pulls back. Then it tries to rally and hit that same high point again, but it just runs out of steam. It fails. That second failure to break the old high is the market basically screaming no. It's a huge signal that the upward momentum is gone and things might be about to turn around. And here's a second tool that often happens right after that, the kiss goodbye. So after the price fails at that double top and breaks down below a key support level, like a floor, it'll often rally back up one last time to kiss that old floor, which has now become a ceiling. It's like it's saying goodbye before it continues to fall. That's your confirmation. It's your last chance to get in the lifeboat before the ship really starts taking on water. And these aren't rare. You'll see these patterns happen thousands of times. Okay, so we have spent a lot of time tearing down the 3 biggest myths in investing. Now, let's build the alternative. Let's talk about a framework for investing that's based on an actual system, not just on hope, and it's called the 4 pillars. And this right here, this is the whole system. The first pillar is fundamental analysis. This is just looking under the hood. Is the company you're looking at actually profitable? Is the real estate in a good neighborhood? Is the asset fundamentally healthy? Pillar 2 is technical analysis. This is about listening to the market itself. Is the price trending up or down? This is where patterns like that double top give us clues. The third pillar is cash flow. This changes the entire goal. Instead of just hoping for the price to go up, we ask, how can this asset pay me to own it? And finally, the most important pillar of all, risk management. This is your insurance policy. It's knowing your exit before you ever get in. It is your lifeboat. Now, the real magic here is how these pillars work together to give you a plan for any market. If a company is strong and its stock price is rising, great, the path is clear. You can profit as it goes up. But here's where it gets really powerful. What if the company is weak and the charts show a downtrend? An educated investor can actually profit from that downward movement. And what if the market is just blah, going sideways, not doing anything? Well, that's where the cash flow pillar comes in, letting you generate income even when the price is flat. This is the difference between hoping for just one outcome and being prepared for all 3. up, down, and sideways.
So as we start to wrap this up, the one theme that really connects everything we've talked about is education. All those myths we busted, they only work in the dark. They thrive on ignorance. The alternative we just built, the 4 pillars, that's built on knowledge. The difference between gambling and investing, between being at the mercy of the market and being in control, it's just education.
And this quote just says it all, doesn't it? Risk isn't about whether stocks are risky or real estate is safe. Risk comes from the investor. It comes from not knowing what you're doing. It's that simple. When you're educated, when you have a system, you can reduce risk and you can see opportunities that other people who are blinded by fear and ignorance will miss every single time.
So I'll just leave you with this one last thought. Is your financial future going to stay in the hands of someone else's generic boiler plan? A plan that might be built on the very myths we just took apart? Or are you ready to take control, to get educated, and to become the true architect of your own financial life? The choice, as always, is yours.